Okay. Oh, it's interesting. I feel like no, it doesn't have, it has like a pre-screen before we actually start.
Oh, really?
Yeah.
That's cool.
Unless it's just not playing. Oh, no, it doesn't have a pre-screen. We've just been saying all this on here.
Oh, what do you know? Fantastic.
That's even got me drinking my liquid death water.
There you
All
go.
right, cool. All right.
Love it.
Ready to go live?
Love it.
Ready for me to start this?
Yeah, baby.
Hey, welcome, everybody, to the weekly edition of the Not Your Average Investor Show. Today, we're doing one of our favorite content formats. We call it Not Your Average Insights, where we dive into the latest headlines, what's going on, and we run it through old genius concepts head over here. We're starting today with the Fed's decision not to lower interest rates. Then we're going to get into this idea floating around about Ron DeSantis eliminating property taxes. And then we're going to get into a little article about the 10 slowest housing markets in the U.S. I am your host, Pablo Gonzalez. With me in studio is the guy that I affectionately like to call GC because he's got the genius concepts, knows how to generate cash flow, is a great co-host, and because his name is Greg Cohen. Say hello, Greg.
Hello, everybody. Fantastic to be with all of you today.
Buddy, it's good to be here.
It is so good to be
Right?
here, buddy.
It's been a while.
It has been a while,
Oh,
man.
I'm out of town. You're out of town.
I have taken a few trips. I was just totaling this up from April to July. It's been a whirlwind, a wonderful whirlwind. My family and I have been to some nice places. This time, I didn't go to one of my favorite downtowns, revitalized downtowns. I went to go play some beautiful golf.
Your favorite hobby
out in Bandon Dunes. And for anybody who knows Bandon Dunes golf out there, if you know, you know. It's incredible. So, but we're back and we're ready to rock.
Good to have you, buddy. Good to have you. Faithful have been here. The Not Your Average Investor fam has been hanging on to have you back. Last week we had a really good show with Brian Moore.
Tell me about it.
Did you watch it?
I didn't have a chance to watch it yet.
Get a chance to watch it? Oh man, super interesting. So Brian in studio this time.
Yeah.
He had never been in studio, so you had the full experience. I thought the most interesting part of it was I really wanted to focus on kind of like from then to now, all the different times he's talked to us. One big change is the idea that he's like, the money flowing into downtown Jacksonville is now very institutional money. Like that, it's like the capital has like popped up an echelon on awareness. And then the other thing that he told me that I thought was really, really interesting was that Jacksonville has the highest increase in retail cash spend in the nation.
Highest increase in retail cash spend in the nation.
Yeah. So like,
interesting.
So walk around money that people are spending at storefronts and restaurants and whatever, Jacksonville ranks number one.
That's like money in pocket, or is that money that's spent on retail
Money
goods?
spent on retail, like in retail establishments.
Right. Nice.
Yeah.
That's really good to know.
That's
I'm gonna have to find that article.
Spending money.
Yeah.
That's
so if you're an
of like
institution,
quality of life and wages versus cost of living, right? Like.
So if you're somebody who's making a decision on an institutional level and you're like, I'm going to go and put my capital in the next great American downtown, you see the work that's being done with Gateway Jacks and Brian at the helm, and you also see the opportunity for dollars to flow into those amenities that are being created by Gateway Jacks. And you're like, I'm institutional capital, I'm going in. And that's why we have such a rush of institutional capital.
Yeah, pretty good, right?
I love this, man. I should probably watch the show.
I love that man too. I've been trying to talk Brian into being my friend. For the record.
You and me both, buddy.
I've been like, Brian, if you ever need to go to a networking event and you need a wingman, like I'll go. He's like, yeah, sure, cool. Anyways,
he's like the coolest dude.
He's super cool. All right, GC. I feel like we missed something. Is there something that we're supposed to do when we start a show?
Ye old roll call.
We got the leadoff hitter kicking us off today, John
Henning.
We got the ringmaster in the house,
Andrew Barnhill.
HTTN.
All right, HTTN.
Good to
fantastic.
Have you. HT said that they just bought a property.
No way. Fantastic. I've been a little out of the loop. I've been on vacation. Yeah. Congratulations, HT.
Flora Colby from Washington State.
Flora.
Back. Our regulars, Gary and Rosalind Riley from Marietta, California.
We regard you.
We got the MVPs in the house.
Mr. Lee Bishop.
We got the early bird in the house.
Mr. Dean Curry.
The KOB, King of the Beach.
Christopher Lee from Fernandina Beach.
We got Il Maestro in the house.
Don Williams.
Don Williams from Long Island, New York. We got Leo Faraganan.
Dun, 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 dun.
Faraganan.
Dun, 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 dun.
We got the Monsieur.
Reggie Fonseca.
Reggie Fonseca from the island of Bahia. Good to have you, Mary Rockoff, hanging out here.
All right, Marie.
Good to have you back, Marie. Our favorite smile from the Pacific Northwest.
Pamela Myers.
Pamela Myers, of course. The better Greg.
The better Greg Stone.
Howdy from New Jersey. Who else we got in? Oh, Big Papa's in the house. I love it when he calls it Big Papa.
Pops is actually in my house in the house. He's up visiting right now. So Pops, good to see you, my man.
Yeah, good to see you, Big Papa. Co-founder of the co-founder. Rob Joseph, from Virginia.
New name?
Rob, new name.
New name.
On the show, Rob.
Welcome to the party.
Make yourself comfortable. We got the Maven from the mountains of Denver.
Leslie Wilson.
Leslie Wilson, good to have you back. Who else we got in here? All right, good roll call today. I like it. Of course, Eddie Harris.
Hot Atlanta.
From Hot Atlanta. And Saren is here from New Jersey.
All right, Saren.
Welcome back, Sarah. Jerry Kreshman is Jerry.
Jerry, great to see you, Jerry. We love having you here.
Good to see you, my friend. All right, you see. Topic du jour. It's the topic of the day.
I've heard that.
You've heard that. Fed had their meeting. They made their announcement last week. We were talking about it as it was coming up, like, oh man, if the Fed rolls back interest rates, we got a big show on our hands. And quack quack. Yeah. They did not roll back interest rates. In fact, they just decided to keep them steady. It feels like the economy is in a good place. Inflation is down. The numbers look good. But they cited something else. They cited uncertainty around tariffs before they roll it back. Is this just another example of the coil being coiled, GC?
Yeah. Ultimately, the coil that we've talked about is literally, we have seen the data show us that when interest rates rise on a percentage basis, like they have risen, which does not have happened very often. The last time it rose like this was 40 years ago. And when that happens, and then they stay up higher for longer, all that's doing is it is taking home sales that would have happened this year, it's pushing off into future years. And ultimately what that's taking is home price appreciation that would have happened this year, it's pushing it off to future years. So yes, when you see a lack of an announcement or the Fed announcing that they are keeping rates steady, ultimately what that means is, for that component of what drives our long-term interest rates, it's not going down. And so that means higher for longer interest rates. And that means ultimately it's taking the demand that is happening, that would have happened today, pushing off for future years, which for us, for those who are not your average investors, who are clients of JWB, you are buy and hold clients. Yeah. You are buying and you are holding for the future. And so what this is ultimately doing is suppressing demand today. It will be realized in future years. And that's kind of how it's going to affect home price appreciation.
Got it. Yeah. So, we titled the show "Tariffs already affecting the housing market," right? Like this is when we first started thinking about tariffs affecting the housing market. We were like, well, supply chains and the cost of wood might go up, and like all these different kind of like long tail things that would happen. We did not expect something so like direct to be right, like the Fed's decision on interest rates being blamed on this might be the most direct kind of like attribution to something that could impact the housing market, right?
Definitely. Yeah. Yes. This is having a direct, the thought of tariffs may be the biggest effect of housing prices in 2025. Just the thought of tariffs, not necessarily tariffs, because let's face it, some have been enacted and then taken away and delayed and then pushed forward and increased and then nobody knows really how the tariffs are going to land. But the thought of tariffs, ultimately, what I think is happening is the Fed appreciates cover here. The Fed appreciates cover for not dropping interest rates because, what tariffs or the thought of tariffs create is some cover, right? We don't know how they're going to land, and the Fed is under a lot of pressure to be able to lower the Fed funds rate, which could lower interest rates. But what the Fed is really concerned about is they want to learn from their past mistake. If we go back, whatever it was, 3 years ago, 4 years ago, 5 years ago, the Feds thought that inflation was transitory at that time, which means that it was not going to be long lasting and it wouldn't have a big effect on the economy. They flat out got it wrong. And that's not my opinion, just my opinion. The Fed has admitted that. They came out and they said, my bad. We didn't know what transitory meant before. We all know it now, and they got that wrong. Yeah. So I think what they are trying to do is, it certainly doesn't hurt for them to go a little bit longer to make sure that they have inflation under wraps and in check, because I think, if the Fed was to bring us right back to inflationary times again, that would be worse pain from the Fed's perspective and probably for our country
Yeah.
than the pain of, um, some labor losses, some job
Yeah.
losses, because the Fed does know if as soon as they start to drop the Fed funds rate, that is going to ignite this economy again. So I think when the Fed hears about tariffs, nobody really knows what tariffs mean for this. Nobody really knows how much it will lead to inflationary prices because of tariffs. Nobody knows if they're going to be enacted. But one thing that we know is that the thought of tariffs could lead to inflationary measures. And the Fed certainly doesn't mind the cover that is provided by giving them an out to not decrease the Fed funds rate. Does that make sense?
Yeah, that makes sense. I mean, what I'm hearing is essentially what's going through my head as you're telling me this. I'm like, is the Fed kind of happy with this kind of in between right now, right? Like if the economy can be so strong and look so good with high interest rates, isn't it better for the Fed to be somewhere in the, hey, interest rates historically are not high, right? Like these interest rates, if you look back 30 years, they're not super, super high, right?
Right.
They're high over the last 10 years. But I would imagine if I'm the Fed, I want space to be able to go down or up. Like if all I can do is go up or all I can do is go down, I'm just kind of like in an imbalanced position and I don't have
True.
levers to pull.
And that's where the Fed found themselves not too long ago.
That's what I'm
They,
saying,
they had
right?
no way to go down, and that's why they created other measures to inject money into the economy, which we don't always know what the consequences of those are. So yes, to your point, the Fed wants to have the maneuverability to be able to go up or down.
Yeah.
But let's just go back. Let's give the Fed some credit here.
Yeah.
I mean, just as much as they screwed it up by calling it transitory and missing on that, the Fed has done an incredible job of this soft landing.
Yeah, we really have.
I mean, let's call a spade there, right? We have achieved up till this point, we have achieved a soft landing, right? We have not been in a recession. Our economy continues to grow. Our labor market has been stronger than most expected.
Yep.
And so a lot of credit goes to the Fed actually managing that incredibly hard to manage ship in a direction. I think what the Fed's job here is a dual mandate, right? They need to keep inflation down. They want it to be at about 2%, and they need to keep unemployment low. And that's always been their mandate. The problem that the Fed has is that all the information that they need to make decisions is very lagging.
Yeah.
It's very lagging. So they have this huge cruise ship that we've got, in managing the U.S. economy, and they have insufficient and slow data to be able to do it. So the Fed, I think, and you know what, this is just one man's opinion. Listen, I'm commenting on what I'm reading and hearing and seeing what the Fed's doing. But if I were in their position, instead of getting it 100% right, I would be trying to focus on getting it less wrong. And I think that's what they're doing. And is it less wrong for them to maybe hold interest rates a little bit higher for longer? Does it give them an out to make an easy correction if they see job loss starting to happen? Sure, they can just lower interest rates. Versus, the really hard thing that we have seen is hard to tamp down. It takes a long time, and it negatively affects a lot of people in our country is when inflation ramps up. So if the Fed was too quick to lower interest rates, if they just discounted what potential effects tariffs could have, they could reignite this economy. Housing would be the very first thing that would get reignited if they made a substantial drop to interest rates. And then the information that they have is lagging to correct it as well. And it's much harder to tamp down inflation than it is to ramp up jobs.
True.
So that's just one man's opinion on it. But ultimately, what we have seen is that the Fed has held the rate steady. There's some interesting, I don't know what you want to call it, chinks in the armor, though, as far as how they came to this decision this time.
I was going to ask you about that, right? Like you were telling me that you were like reading into like the jobs report and a couple of different things. Like, tell me more about why this isn't. You were telling me that this isn't like we just called tariffs air cover for them not raising rates, right? Tell me what they're covering for outside of outside of maybe getting it wrong.
So some interesting things. The decision to not lower rates was on July 30th, I believe. Okay. And very interesting jobs report came out right after that. So the Fed did not have that information when they made the decision to keep rates steady. And when the Fed made the decision to keep rates steady, they said, we don't know, I'm paraphrasing, we don't know the effects of tariffs, and we believe that there could be inflationary effects from prices that are a result of tariffs. So we don't know. And then what they've also said is that the job market is, for lack of a better word, it's been resilient. The job market's been resilient. If they started to see the job market start to falter and start to see a lot of job losses, that may change their equation when it comes time for the next, potential change, which is in September, if I'm not mistaken. But they didn't have this jobs report. So the tariffs thing is still hanging out there. They make their decision to keep the rate steady. The next day or within a couple of days, this job report comes out. Now, a jobs report is interesting because it looks at the jobs that are added, and it's all about the expected jobs that the economy is supposed to add versus how many jobs are actually added. So it's not about a number. It's not like if it's 100,000, it's good, or 50,000, it's bad, or whatnot. So what is the expected? Well, for July, the jobs was actually a little bit lower than expected, which is a sign that you could potentially have some job losses or not having as much job growth for the economy. It's a sign of potentially a weakening labor market. But what was also very, very important in that jobs report is the revisions from the previous month's jobs reports. And this is just as important or even more important because in May's job report that was revised means they reported in May. From that point, they actually went back, revised the number, and lost 125,000 jobs just in May. And then in June.
So May's report was 125,000 jobs higher than what it actually was.
Yes. Okay. So that's what the Fed was using at that moment to make decisions whether or not to lower the Fed funds rate. They didn't have this information that they had been revised. That wasn't the only one. June, the same day that jobs report here was released here recently, they revised May and June. June's jobs, new jobs added, dropped by 133,000 jobs.
The forecast versus the actual job is not like that we lost 143,000 jobs in the US.
Correct.
We just missed expectations by 143,000.
Not necessarily that. It's whatever they told us the jobs, the new growth was in May. I can't remember if we missed expectations or hit expectations there. Whatever they told us, it was actually 125,000 lower. So we missed it. At that point.
That's May, but then June, you said they all
same thing in June. So we missed it.
June. Okay, and we just released July. I was just
okay. So they revised May, they revised June. June, whatever they told us in June was the job number, is 133,000 jobs lower. So this is new information. Now does this mean that there's some weakening in the labor market? We're starting to see some potential signs of this. This would be 3 straight jobs reports that we have been below expectations. Does that change the math and the equation for the Fed when they come and sit down and think about what they're going to do for the Fed funds rate in September? We don't know. There's other things that are starting to potentially show some signs of potential weakening. But one really interesting thing, when the Fed gets together and they have this this committee that comes together and decides, it's I think it's 9 or 11 bank presidents that make up the decision makers within the Fed. This last time, 2 of the presidents who have a part of that decision dissented from the opinion.
Yeah, that's right.
They try to be consensus all day, every day. This is the first time in the last 30 years that you've had 2 of the bank presidents dissenting. They wanted to lower rates. So you're seeing some new information come out from this last report that I'm really interested to see what happens in September when it comes to the Fed's decision.
Really good summary, man. Wow, that is super interesting. So next one should be very, very interesting, given that 2 have dissented, the jobs are lower than we expected, right? Like those are all.
We'll have at least one more jobs report coming out, maybe another 2.
We'll have a month into the tariffs, right? So like maybe there's some data there as well.
Exactly.
So the next one should be watched. Final kind of like takeaway here, GC, as far as like the Fed not lowering because the tariffs are not as a buy and hold rental property investor, like what I'm hearing is, man, this is more displaced demand. We continue to wind the coil, right? Like we continue to tighten the coil. That means that there's going to be like a bigger recovery on the back end. Is that what you were seeing then? Is that the final takeaway?
Yeah, absolutely. I mean, ultimately, what we see on average every year, and this is going back since 1982, on average, home prices appreciate at a rate of 4.8% per year in Jacksonville. And I've done the math. It's usually somewhere around, call it 3.5 to 5% every single year. And you're not going to see that this year in Jacksonville. So if you subscribe to that theory that markets are cyclical, that home price appreciation repeats itself over a full market cycle, then the math just signifies that you would see higher than normal home price appreciation to make up for this at some point in the future. And that math plays even if your population is steady, right? We have a population here in Jacksonville that is growing at a significantly higher rate than the national average. And we have all these other good things that are happening here in Jacksonville. So yes, the fact that we have continued to have higher for longer interest rates, is it, would I like interest rates to go down? Sure. If I'm just putting my, real estate investor hat on, yes, I would like for them to go down. But I understand it doesn't change my plan at all.
Yep.
It doesn't change the plan at all because you're investing for the long haul. You're buying and you're holding. And whatever the Fed is deciding to do to hold interest rates up right now is just suppressing or delaying demand that will reinvigorate as soon as interest rates are dropped, which could be starting to happen in September. Who knows?
Yeah. One of the values of buying into this asset class is this like long-term perspective and being able to see things and not have to overreact and just kind of like be in it for a long market cycle and not be, not have your heart rate go up and down over time, right?
There you go.
All right, GC. So let's go to the next story. In the Not Your Average Investor WhatsApp chat, it was shared that there is this idea being floated around by Florida Governor Ron DeSantis to eliminate Florida property taxes. I believe that this is for homestead taxes, right? But
yes, homesteaded property. So your primary residence only.
For primary residences, right? So that would not go into effect for our investment properties, but it would still affect home prices and all this type of stuff, right? Like what are your thoughts overall on this proposal?
Well, I'll kind of take it from three lenses. I'll take it from the JWB or the not your average investor lens, like the rental property investor lens. And I'm purely just thinking about maximizing, for that. Then we'll look at the overall, call it state of Florida, right? How does this affect our citizens and our community in the state of Florida? And then we'll talk about, is this likely to happen? Sure. So if I'm thinking about from a rental property perspective, a rental property investor perspective, if this was to go through, this would absolutely increase your return on investment significantly. This would absolutely change the trajectory of home price appreciation because we would be the only state in the country that does not have a state income tax and does not have property taxes. And while we already have relatively low property taxes in the state of Florida compared to other states in the country, the fact that we would not have any property taxes on primary residences, this is the state that people are moving to probably more than most anyways. You would see more and more people come here. And what would that mean for us? Well, it wouldn't mean that we would eliminate our property taxes for the rental properties that we own as rental property investors. But you got to think about how our values for our properties are how they come to be. They come to be based on what the home prices are of the things that sell around our rental properties. So as property taxes would be eliminated on primary residences, which are right next to the homes that you own with JWB and the ones that you all own and the ones that I own, those market values would go up dramatically. It would help with home price affordability for those primary residences, and it would drive significant demand and population growth. And so by default, our return on investment would go up because our home price appreciation would go up.
It would help with home price affordability in the short run, right? Like all of a sudden I could go get a home minus the property discount of like what property tax discount of what I thought I would be paying on a yearly basis cost to live there. But long term, it would probably lead like this this rapid rise in home price appreciation that would happen because of it would probably start maybe like the conversation would turn around at some point, right? Like,
Given everything else staying completely
yeah,
constant,
yeah,
yes. However, we know things are not going to stay completely constant. But yes, if this is in a vacuum, what would happen is home prices would go up so much to the point where home price affordability would become a concern again,
yeah,
even without property taxes.
yeah,
Which, again, if we're just thinking about our return on investment, means that home prices would go up so much that we would have a nice return on investment. It's not the end all be all, though.
yeah.
That would solve the problem.
Yeah.
And that's part of the reason why people are some people are for it and some people are against it. Something else that may happen, though, that's related to the first segment here is there could be a world where property taxes are eliminated on primary residences in the state of Florida, home values go way up, interest rates come down.
Sure.
So then your affordability still would be there,
Yeah.
Or at least have a longer runway until affordability would go. So there's a lot of things that could change, but ultimately it would be a great thing for all of us who own the assets if this went through.
Yeah. Okay. So that is in a vacuum. What would happen to the assets? They would go up. The plan as it's being kind of presented, right? Like that means that I guess Governor DeSantis is trying to push for we can do this just by cutting government expenses, like state spending. Other people are saying there's no way that you're going to be able to do this. That's way too much of a gap. You need to increase the sales tax, which now becomes a consumption tax. Either way, I think if we're going to cut government expenditures, I would say that has to have something to do with the labor market as well, right? Like if the state isn't spending money and spending money into wages and stuff like that. If sales tax goes up, I would say cost of living goes up. It becomes a consumption tax, which we know kind of like it doesn't matter how much money you make, everybody still buys milk and eggs and groceries. So it just like hits disproportionately against lower income folks, which could harm the affordability situation, right?
Yeah.
So multiple things to consider there.
Yeah, that's the big question. And again, what I was just sharing there is only the lens of an investor who is trying to maximize their return on investment. That's not how we need to look at this, right? Yeah. That's not how we would look at any constitutional amendment in the state of Florida, right? So there is a whole lot of ramifications to this. So you talked about government labor maybe being affected. Well, what do property taxes go to fund in the state of Florida? Police, fire, schools, right? Yeah. So, I mean, nobody wants to do away with any of those or any type of significant cut to theirs, right? We want to have more to be able to give to those first responders and those folks that take care of us and of course our schools and whatnot. So it's the gap. How are you going to make this up? And I think that's where a lot of folks are wondering. The thought of eliminating property taxes, which would help with affordability, but might leave 50% of the dollars to spend on services, doesn't make a whole lot of sense to anybody. Yeah. And, from our governor's perspective, he feels like he can make it up and probably in a number of different ways, but he's been pretty forthright with eliminating waste and government spending. Most people feel like that would be insufficient. I think it's like $40 billion that he would need to make up. And so that's why a lot of the think tanks and those who are looking at this and saying, is this even feasible, are saying that in order to do that, you need to increase your sales tax from 6% in the state of Florida to 12%. And as you mentioned there, and I think this is the biggest thing that, again, just my opinion, because this is not your average insights, right? Yeah. I get to do that. Yeah. That's the biggest red flag for me is you think about the people who are most affected by this. If we go back to those times when we had huge inflation happening, we talked about how inflation is really just a tax. It's a tax, but it's not a tax that is equally distributed.
That hits everybody equally.
Right? Yeah. The folks who have a very hard time and are living paycheck to paycheck that now have to pay 9% more for milk this year than they did last year are way more affected than those who have the means. And so if we start to think about what a sales tax would do, it would have the same effect, disproportional effect on those who don't have the means to afford it. And, in our company, we typically have progressive taxes. What I mean is when you make more money, you pay a higher percent. We try to avoid regressive taxes, which basically penalize those on a proportional level, those who have the least means to be able to afford it. And a sales tax going from 6 to 12% would do that. So I think that's the biggest reason why folks are against this. And I think the biggest, just kind of like wrap it up, like, is this going to happen? I think it's very unlikely. I think it's very, very unlikely that it would happen. I think you would have to get to a place where the dollars made sense for everybody to support this. There's certainly some advocates and some good things that could happen for this. Growth in the state of Florida would be off the charts, but you'd have to get to a place where the dollars made sense to be able to make up the difference, and who is being affected by those dollars has to make sense. And that's where a lot of folks don't see it. So it seems unlikely, but the governor is going very strong with it, and he hopes to have it as a constitutional amendment in 2026.
Definitely getting some headlines, right? Like definitely more attention to the state of Florida and more like, conversation around it all. Jerry Krishman asks, could the loss of property tax revenue for the state be transferred to the rental properties? I guess that's another externality, right? Like if they're not going to tax homesteads, right? Like maybe they transfer that tax over to rental property investors.
That was my first question, actually, as I started to do some research there. So, Jerry, great question. I read a few articles on it, and I saw not just that there was no mention of it, but specifically they mentioned it would not be passed on to rental property owners.
Oh, interesting.
Yeah. So the governor has made that clear. So I think, it goes back to the same argument. You want to own things that are in demand, that are in high demand. And owning property in the state of Florida, specifically in Jacksonville, is something that is in high demand. We see that because of the population growth numbers. So however this lands, whether it happens or it doesn't happen, there's something in between. The governor has talked about a rebate of property taxes up to, I believe, $1,000 in 2025. He's trying to get that going. However this lands, you're in a good spot if you own the asset here in the state of Florida.
Okay, good to know. Leslie Wilson says, thank God for that. I agree. A couple of questions from the last segment here. Leslie Wilson asks, any ideas why there's so much revision to the past government job numbers? I think they get payroll info from payment services like ADP. So how can there be so much revision? Do you know the character of these jobs? Like, are there summer jobs, permanent jobs, stuff like that?
I did a little bit of research on this, so I'm still trying to understand it myself, Leslie. And maybe I'll post. I'll make sure we post the article that I read on it in our WhatsApp group within the Not Your Average Investor community. So what I've come to understand, and I have a lot more understanding to learn. So feel free, if anybody knows more than me on this, chime in. It's that the market is in a rush to understand the data, and we have 1 month numbers for the jobs report. But everybody knows that is an insufficient amount of time to be able for the government to receive all its information from ADP and from these other payroll companies that provide it. So everybody sort of understands this. And then there are some, call it bond traders and investors out there, who take that 1 month data and they say, you know what, I'm going to take action on that. They know that data can change. But they say, hey, it's a good risk return for my clients or whoever I'm trying to make money for to go ahead and make that decision. But they know full well that it is insufficient amount of time for the government to receive all this information. So it's not unique to have revisions to data that might be 2 months old, 3 months old when it comes to the job report. It's just not realistic for the government to receive it that quickly.
Yeah, it makes sense, man. I was thinking about back in my days when I used to work in Fortune 500, we'd have like every month my division, I would have to give them hey, what I think I made, what I think I made this month, what I think I'm going to make next month kind of thing. Like just keep doing those prognostics. And most of the time we would just be like, well, what I did last time, what am I doing this month? Just like tweak a little bit here and there. Like those estimates before they come back and actually like look at it all are pretty preliminary when as far as like the real-time data stuff goes, right?
I think what you're talking about is like estimating in the near future.
Yeah.
Yeah. And that's about the best. So like the government, this is actually data that they received in the past, but let's just face it, the government's not going to be anywhere close as in terms of turning around data that a private enterprise is. And it's just not realistic. So don't be surprised. It sort of makes more headlines when these revision numbers are substantial.
Yeah.
So the fact that there was 258,000 jobs revised in one report of revisions is what really made a lot of noise. And I did want to add one further point. We forgot to talk about this in the first segment. What do you think interest rates? I'm not talking about the Fed funds rate now. What do you think interest rates have done over the last week?
Oh, gone down.
They've gone down. Thank you. Thank you. We had a little prep show about this.
Yeah.
I was like, hey, interest rates have gone down. I'm gonna tee you up for that.
Yeah.
It's good that you got that one.
I did. I did. So they've gone down whether or not the Fed held the rates steady, regardless of tariffs, regardless of whatever.
They've gone down pretty substantially. I think it's the lowest since I believe October of last year. Sometime, maybe 6 to 12 months from now. So interest rates today, the average 30-year interest rates under 6.6%. So it's gone down probably 2 to 3% just in the last week. That's substantial. Now the Fed funds rate hasn't changed. They held it constant. But what's happening is our interest rates have actually come down. So again, this is proving what we have talked about multiple times on this show, is that the Fed funds rate and all the noise that we hear about what the Fed chair decides to do with the Fed funds rate does not necessarily mean what happens to our long-term interest rates. So if you were to buy a turnkey property today, you would likely get an interest rate that might be 0.3% lower than what it was just even a week or two ago.
Interesting.
And that's because of how the bond market and because of investors who invest in mortgage-backed securities reacted to the jobs report, not necessarily what happened to the Fed funds decision. Pretty cool, right?
Pretty cool. Pretty cool. Yeah.
Another fast fact here. All right. So the difference between treasuries, 10-year treasuries, and what our average 30-year mortgage rate is about 2.4% right now. That's called the mortgage spread.
Okay.
Okay. Historically, that number's only been 1.7%. So if we're looking at ways that we can get interest rates under 6% without the Fed deciding to lower the Fed funds rate at all, if we could just get enough people to want to buy mortgage-backed securities or to buy 10-year treasuries so that the mortgage spread would go down to 1.7%, we could be sub 6% interest rates without the Fed changing anything. So I think that 6% number is really big. I think that would ignite the housing market. So who knows if this is the beginning of dropping that spread from 2.4 to 1.7, but if it does, that would be a really great sign for us.
Interesting. Okay. All right.
There you
So
go.
just goes to show that it's not just like a one stat thing, right? It's not just what the Feds does. It's not tariffs. It's like the whole picture is what affects mortgage rates, right?
Right.
So it's nuanced. Jerry Kreischman says, oh, based on this thing that we were talking about on like reporting the numbers and the labor, I've read that many companies have been hesitant to provide guidance on their stock due to tariff uncertainty, and that carried over to their reporting on labor and jobs data. So that might explain something.
Interesting. Yeah. And, there's a lot that's just kind of unknown about how people are reacting to the thought of tariffs here. And that might be another example of that.
Yeah, there you go. And then the early bird, Dean Curry says, back during COVID, JWB was buying containers of supplies, flooring, lumber, cabinets, etc., to help improve the supply chain shortages. Is JWB buying in bulk now to get the best deal ahead of tariffs kicking in?
No, we're not. And I'm not even sure if tariffs are going to have a substantial effect on housing prices because we don't know.
We don't know.
We don't know. I've seen some data. I've listened to a few of the webinars and some of the white papers that John Burns has put out about what really is going to be the effect on housing prices, or excuse me, materials when it comes to building homes. And their number is about a 2% increase. Now, that's a lot lower than the 145% we've heard with China or whatever the percentage is right now. So, that's their analysis when it all comes down to home builders. I just think it's way too early to know. And I think a lot of people in this place, we're not going to be in a position to put more capital and have to figure out how to stock and warehouse all of these additional supplies. We don't know if the tariffs are going to be here, or how much they're going to be here, or whatnot. And I think that's how a lot of people are going about this in the home building industry as of today. We're all in wait and see mode.
Okay, makes sense. And then Lee, the MVP, says, how does the money for the JWB Cares thing doing? Do you know, GC?
I haven't checked in the last week, but I think we were over $2,500 that we raised just from our community here. So if anybody would like to go and donate to the JWB Cares Welcome Home Fund, we are continuing to raise money. We're going to keep this open. Our goal is to raise $20,000 that will be gifted to a member of the Jacksonville community and a member of our resident community here at JWB who wants to become a first-time home buyer. They're going to get a $20,000 down payment assistance from you all. And so we were over $2,500 before. If you would like to donate, we would love your support. This community is amazing. So to kickstart it with $2,500 is just awesome. So first of all, thank you.
The link is jwbcares.org slash.
Go to a different one. Go to donate.jwbcares.org.
I'm just typing it in so that I can share it.
I think that's it.
jwbcares.org. Oh, KJ chimed in 2167.
There we go. And there was some additional folks. I know Ken Moline donated outside of this link as well. So I believe we were over 2,500. Yeah. So you guys are awesome. Thank you very, very much. And let's continue. If you guys can open up your hearts and your wallets a little bit, help get us closer and closer to that $20,000 goal. There will be one additional family that will be able to become a new homeowner because of you guys.
Love it. All right, you see, last headline here that we're going to go through also came from the Not Your Average Investor community here in, let me see, where is it? I'm looking for this right here. So Yahoo put out a list of the 10 slowest metro markets right now, right? This is the headline is the 10 slowest housing markets in the US. We got a little graph here. If you look at this infographic, you see that Jacksonville is in here as number 5. The markets in order is, by the way, the stats here are biggest percent change in slowdown year over year from June this year to June last year, right? So it says number 1 is Nashville with a year over year change of plus 20 days, median days on market of 52 days, median list price of $548,000. Miami is plus 15 days, median days on market 83 days, median list price also over $500,000. Orlando plus 15 days. Anyways, I'm not going to go through all of these, but Orlando, Tucson, Jacksonville, Columbus, Ohio, Las Vegas, Riverside, Tampa, Florida, and Raleigh, North Carolina, right? Raleigh.
That's right. Good job. You look like you needed a pat on the back there.
I appreciate it. Correct myself there. GC, when you look at this list, what's the first thing you think of?
I don't even know why I'm wasting my time reading this article.
I'm sorry.
That's the first thing I see. Yeah. I mean, I don't know where you get this data. I mean, I report on our days on market in Jacksonville every quarter as part of our quarterly market update. We'll be doing that again middle of September for the group here. So you'll get to see what the actual real number for median days on market is. It was not ever close to 67 the last time I reported. I think it was 41. So I really question the source of the data every time I see an article like this. And I don't do this every time now because it takes time and I already know what the punchline is. But every time I get an article like this and I dive into it and I actually find out the source of their data, I am less than impressed. It is, there's data flaws all over the place. They're referencing like 16 other people that actually, forwarded the data or claimed the data. And it's just bogus, really. I don't trust the data. I could find 10 other articles that talked about how Jacksonville is the best place to invest and how Florida is the best place to invest. I could actually put the numbers here, which is, if you want to talk about where to put your money over the last 10 years, putting your money in any of those top 10 right there is probably a good choice. Yeah. So I don't know. I have a problem with articles like this in general because they don't help investors make decisions. They are just there to catch headlines. I have not read one of them that I actually felt was a data-driven article that actually gave perspective. So you're getting a little bit of negative GC here, but I think it's a waste of the paper that they printed it on.
Thank God it was online, man. Jeez. Normally you're way kinder than this, Greg.
I don't know.
Okay, so to summarize there, Jacksonville, it says 67 days on market. You know that it's 41 days on market. So that is a one glaring kind of like miss on data. You're sure that there is other things that like they're probably messed up and whatnot. So like the data just right off the bat pings for you, right? So we could kind of like throw some water.
Now that I've vented a little bit, vented, let me give some analysis here. Is the market slowing down in Jacksonville from where it was a year ago? Yes.
Yeah.
Absolutely. Yeah. Is it slowing down in Florida from where it was a year ago?
Yeah.
Yeah.
Has it probably slowed down in Columbus and Nashville and Vegas?
Right. And because if you look at the previous, 4 years, these were the markets that gained the most, So in any investment, you're not always going to be the highest gainer. The ones who are the highest gains are likely to be on a list that they put together for the biggest slowdowns or whatnot the next year. So To the point of, has the market slowed in Jacksonville from where it was a year ago? Yeah. That's why we've been talking about this coil effect.
Yeah.
That's why we've been talking about higher for longer interest rates and home price affordability and how does this affect it. So I'm not surprised. I do expect the market to continue to slow down in Jacksonville in terms of days on market. Whether the number's 41 when I reported or 45 or whatnot, it's not going to be 67. But the point here that Jacksonville and the Florida markets have slowed down is real, and it also doesn't matter when it comes to things like your return on investment for buying properties in a market like Jacksonville, Florida.
Tell me more, right? So it doesn't matter for return on investment for buy and hold rental property investors because we're not focused on short-term metrics, because that, like at the end of the day, if you think of a pro forma of the difference between like 41 days on market versus 44 days on market and the amount of turns that you're going to have, it's a small impact on like those like extra days. Like what's the
like 41 days or whatever the number will be when I report it, call it 45 or whatever it'll be. I mean, that is a healthy market. So you go and you compare that to what it was in 2019 and it's about the same type of number to be able to sell a house those days on market in 2019 versus what they were or what they are here. So when I reported 2 quarters ago, the number was actually lower than what it was in 2019. So there's a little bit of just kind of like recalibration for what does normal look like in a sales environment in real estate. And so call it 45 days is very normal. And if folks were in this game for a long time prior to 2020, they would have realized that 45 days is normal and it's not noteworthy. And then, why do I say it doesn't matter? Well, it just comes down. This community largely is buy and hold, right? So I feel like I'm speaking to our community here. It doesn't matter if you are buying properties to produce a financial outcome, call it 5, 10, 20 years in the future, right? Whatever is happening in this article doesn't matter. Stick to the plan. Where it could matter for folks is folks that are buying and flipping properties. That is a much riskier proposition. And if you are buying properties today to turn around and sell in 3 months or 6 months or sometime around there, you could face substantial interest rate risk or other challenges that can make it less profitable for you to flip a property. Or if you're a homeowner who just bought your house recently and then there's a job loss or something like that, and you need to sell quickly, or there might be some other family challenges, those folks are affected. So when I say it doesn't matter, I'm being, myopic in my view of just talking to us, right? It really doesn't matter for those of us who are buying and holding. And even those who bought, let's say 10 years ago, that may need to sell right now, I say it doesn't matter right now because you're playing with the house money. Think about all of the gains that you earned over the last 10 years in home price appreciation, cash flows, rent price appreciation. And even if it's a little bit slower, or even if home values would decline 1% year over year, you are way beating your return on investment. So even for those who are rental property owners that need to sell right now, and maybe there's a life situation, I know that your money's doing really, really well. For those who are coming in right now, just make sure you're buying and holding. Do not come into rental property investing right now if you need to sell in 1, 2, 3, 4 years. This is a long-term investment. That's how you win.
Welcome back, Greg Cohen.
There you go.
I was like, who is this guy?
Sorry. You bring me on insights now, and I just feel so comfortable. I just let it rip.
Yeah.
We should put like an insights, like the first insights we ever did versus like right now. I'm letting it rip, man.
It's great, man. Like I've been telling you to let it rip. Right? Like this has been a long going process. I was very proud of you for going so negative, and then I was really like enjoying you coming back to being usual Greg. I like it. These golf trips look good on you, man. I don't know what to tell you. I don't know what to tell you. All right, so this is basically a non-news, whether it is the data seems shaky, but at the end of the day, when you are a buy and hold investor, this is kind of like not a thing. Like this is more important for other types of real estate investing. There is truth in the fact that the market has slowed down. That being said, over the long term, we expect for the pattern to repeat itself as it always does. Buying and holding today is as good as it's ever been. And Jacksonville itself, the thing that I look at on this list is a lot of these cities are way higher price points too, right?
Yeah.
Like there is also like a certain level of kind of like insulation that comes in being in Jacksonville, right? Like in these cities, I think of way higher price points for like the Nashvilles, the Miamis, the Orlandos, right? Like
Mm-hmm.
and then and then I'm you know the Raleigh, the Tampas of the world, Riverside, California by a mile, right? And
Mm-hmm.
then I also just think about the idea that I don't know what the economy is in Columbus, Ohio, right? Like I know that the Las Vegas economy is probably not as well rounded as the Jacksonville economy, right? Like
Mm-hmm.
when I just think of lower price point in Jacksonville, super well rounded economy
Mm-hmm.
of, you know, boring city, right? Like we're not the city that everybody thinks of for tourism. We're not the city that everybody thinks of for these kind of like hotbed pieces of the market. We're just like a stable economy as well. I think of a market that's able to absorb this kind of thing a little bit better as well.
Yeah, I think so. I mean, I think, listen, the reasons ultimately it comes down to, do people want to move?
Yeah.
Like your greatest scorecard for how attractive you are as a city is, are more people moving there.
Yeah.
We're doing pretty darn well on that scorecard for Jacksonville specifically, in the state of Florida. People want to be at. So, and that scorecard is not just important for like how well are you doing as a city, like the value that you're offering for moving there. That scorecard is a huge leading indicator for how much money you're going to make in your rental property portfolio over time. Population growth is a large driver of home price appreciation, and home price appreciation is the largest driver of your wealth accumulation within rental properties. So these markets have sustained a lot of population growth, and part of the reason that they're doing that is because of their robust economies, right? But not every economy is built the same way, right? You mentioned Vegas, right?
Yep.
Highly tourist, right?
Yep.
All tourists, right? Well, that economy has risks that we saw during COVID time.
Yep.
And it's not just COVID time, other times where, recessions happen, a tourist driven economy is the first one to experience significant, declines, versus an economy that is built on shipping, logistics, military, healthcare,
Yep.
right? So when we talk about boring, when I want my money in boring,
Yeah.
boring type of economy drivers.
Yeah.
So yeah, that's it. There you go.
This is fun, man. We
Yeah.
haven't done a Not Your Average Insights in like it feels like forever. It
I
feels like a
know.
full quarter since we did
I
this.
think so. We have at least a couple that we planned for this quarter, right?
Yeah, we have a couple plans
Yeah,
for
two
this
or three.
quarter. Yeah.
Yeah.
This is something like we've been missing. I think it was like in the run up to the meetup and like all the different things that have happened. We haven't done one of these Not Your Average Insights, but man, feels good to be back in here and
It
hearing
does.
your riff and going through the things. I love the questions brought up by the community, right? The community makes this show particularly special because they get to contribute and be part of this conversation. So thank you for showing up middle of a work week on a Tuesday. Never take that for granted. Next week, you know who we got in house? You know who we're
Is it Patron Santorius?
Patron Santorius.
Yes. Can't wait.
The famous Patron Santorius is coming to talk about his investor journey and what he's seeing out there.
Oh,
so
man.
really excited to see him next Tuesday. And from here till then,